Switzerland, known for cheese, chocolate, beautiful landscapes, the Alps, skiing, and also for fine, precision crafted, and very expensive watches. Also known for its status as a neutral state and known for its banking industry. Swiss banks are regarded as some of the safest when it comes to privacy and keeping their clients' identity hidden, with the exception of cases of terrorist threats, of course. But this week, one of those banking institutions, the 167-year-old Credit Suisse, Switzerland's second largest bank, was all over the news as the latest to get caught in the evolving saga of turmoil in the banking industry. Welcome to Gap Chats, the podcast dedicated to all things accounting, brought to you by Gap Dynamics. I'm your host, Chris Brundrett. Mike and I are switching places this week. He's on PTO, so I'm taking over host duties. With me today is Bob Laffler, who you met last week when I was out. We hope you'll join us on our journey today as we share our passion for accounting and help change the way you train. Bob, thanks for joining us again this week. And man, what a week it's been, at least in the banking world.
It sure has, Chris. It's been quite the week in financial services. Obviously, the big news and thing that we've been hearing probably the most about over the past couple weeks has been Silicon Valley Bank, but it really doesn't stop there. There's been other banks as well in the news. We had Silvergate Capital, which was a cryptocurrency-focused bank. They announced that they're ceasing its operations and liquidating its assets after a run on the bank. And then following Silicon Valley Bank, there was Signature Bank, which was seized by regulators amid fears that it would collapse after a run on the bank. So obviously lots of fear in the market, and that's causing these regional banking stocks to drop and put these banks at risk. And now we're hearing other regional banks that are just kind of getting grouped into it with First Republic at risk and getting a lot of attention, getting help now from some of the bigger banks. But stocks are volatile and craziness is ensuing.
It kind of came out of nowhere, in a way. What kind of caused all this?
It's a lot of things are causing this. And of course, there's plenty of blame game going around as far as, who's responsible for this. And I'm sure as the months pass and investigations are done, lots will be uncovered. But I mean, at the end of the day, it probably comes down to just a few things that we're seeing. In the case of Silicon Valley and Signature, it's really just a good old fashioned run on the bank. I mean, banks are built on trust. And when all of a sudden the people that are putting their trust in these banks and keeping their hard earned cash in the banks get nervous, all of a sudden they want to take their money out. And when you have social media and Twitter and things like that going on, it seems like we're getting a really new phenomenon, which is, you got electronic banking and you got social media that are giving you real-time information or lack of real information, however you want to look at it. But the point is, it stirs up a frenzy and people are taking their money out and just immediately, right? Just electronically, boom, get my money out. And what's funny is they're taking it out of these small regional banks, and you got to put your money somewhere, not just in and under your mattress. So they're going to these bigger banks. So the bigger banks don't seem to have an issue. And till our next topic, I guess. But these regional banks are the ones that people are concerned about.
So Bob, I mean, you're telling me that, if I went to the bank today to get my money out, it's not just sitting in a shoebox somewhere.
No.
That's kind of what the root of the problem is, right? I mean, these deposits have been invested. I mean, banks, of course, make loans, but they've also made investments. And, I heard in the news that in the case of SVB, for example, they had to sell investments in order to fund these deposits. And I guess these investments were in a loss position, which created issues. And, when there was this run and these investments were being sold, of course, my thought was, they must have been invested in some pretty risky stuff for it to be in this significant loss position.
Yeah, I mean that's kind of what you would think, but no, I mean we're talking about very safe investments. I mean banks at their best are just so boring, right? Banks should be boring, and I would say that these banks are no exception. They're investing in U.S. Treasuries, some really basic mortgage-backed securities. So they had safe investments. The problem is this this frenzy, this run on the bank, where all of a sudden they needed to come up with the cash to pay off the depositors who wanted their money back. And these investments were tied up in long-term investments. Really, what it comes down to, if you want to put fault in the way these banks were operating, it's a failure in asset liability management, where they weren't really looking at the durations, right? They were investing in long-term securities, and this goes back, a couple of years ago from when the pandemic was going on. And now all of a sudden there was this need for short-term cash, and the only way they could do that was sell these long-term securities. And of course, in this environment, this interest rate environment that we're in right now, if you've got fixed rate assets at a low rate and now interest rates are going up, the fair value of those investments have dropped considerably, right? They've gone down. And so as a result, they're taking massive losses for being forced to sell these investments. And that was, causing a lot of the problem too.
Well, and I think, further compounding this issue, we've talked about this a little bit, Bob and I, but further compounding this issue is these banks, particularly SVB and Silvergate Capital. I mean, they were concentrated in certain industries. So Silvergate was, you mentioned it earlier, Bob, was crypto. It was a crypto-focused bank. And Silicon Valley Bank, I mean, surprise, surprise, is tech industry, right? And highly exposed to the tech industry. And, the problem, I guess it wasn't a problem at first, but, during the tech boom of the pandemic, there was a lot of money going in to Silicon Valley Bank, for example. And hence they purchased these investments, as you mentioned, that at the time interest rates were crazy low. And so, these treasuries that they're in are low interest rate. Well, now we're in a situation where both these industries, the tech industry and the crypto industry, have been having some trouble as of late. And so we're seeing deposit holders were taking money out. And also, it's not just individual deposit holders. We had venture capital companies and others that had a lot of investment in these banks or deposits in these banks. So now they're needing to pull money out for liquidity purposes as these industries are struggling. And that combined with, as you mentioned, these investments being sold at sometimes a significant loss upon the deposits. And then you get people involved in social media and everything else, and the run on the bank occurred, and, here we are, right? So, but so far, this seems pretty isolated to certain, industry-specific regional banks. And I think that's why President Biden this week clearly stated that our banking system overall is safe and secure. And of course, he stated that the FDIC is going to, back these deposits and things like that. But this does seem pretty isolated, right?
It seemed like that was the case, but then along came Credit Suisse, which was the topic of your little intro there, good old Switzerland. And
Right.
and now we're entering a different type of bank because while you can say Silicon Valley Bank and Silvergate are smallish regional banks, you aren't going to say the same thing about Credit Suisse. Credit Suisse is a huge bank. They're one of these globally, systematically important banks that we've identified. They got $500 billion in assets. And now we're seeing concern over bigger banks. So that's really what we want to talk about here, right?
Yeah, I mean, so the news that you speak of, Bob, I mean, what is it, a couple days ago? Seems like forever ago in all this saga, but a couple of days ago, Credit Suisse had a 24% drop in their share price. We'll talk about why, and I know. I guess it was last night, the Swiss regulators said that they would pump some money and some capital into Credit Suisse, and that caused their stock price to come back up early today. But as of this recording, it's not looking good.
Back down again.
It's back down
Yeah.
again. So it's
Yeah.
a rocky road, isn't it?
Yeah, well, and once again, it's kind of this whole idea of, volatility and uncertainty in financial institutions, and the financial institutions that are at least viewed by the investing public as dangerous are the ones that seem to be suffering. And Credit Suisse clearly is not necessarily seen at the moment, by investors with a lot of confidence given their history.
Well, what happened? What's going on that sort of caused this? I mean, obviously it certainly didn't help that we had these failures, earlier in the week or over last weekend, with these banks that we mentioned earlier. But Chris, I mean, what happened to cause them to get dragged into this?
Yeah, I mean, I think what happens here is, you had a bank that has a number of issues over the years, but in recent years they have been saved by their big backer, the Saudi bank, and the Saudi bank actually came out and announced that they have kind of reached that limit as far as what investment they can make in Credit Suisse. They had a regulatory limit of I think 10%, and they were up till the high 9%, and basically they came out and said, look, we're done as far as making additional capital infusions, and that really freaked out the investors. And that's what kind of triggered all this.
And further compounding this issue was right about the same time this week, there was a delay in the release of Credit Suisse's 2022 annual report due to, shall we say, a last minute call from the SEC.
Yeah, and anytime you have a last minute delay caused by the SEC, that can't be good news. That's not something you want to hear.
Yeah, usually that's not good. And interestingly, the call from the SEC was actually related to prior period cash flow statements, which Credit Suisse has revised in its 2021, so the prior year annual report. And, I guess the SEC was satisfied with the call because shortly after, the bank did release its 2022 annual report.
Yep. So they got things all sorted, I guess. But as a result of that call, management had to report a material weakness surrounding their internal controls over financial reporting. So, and that unfortunately affects not only their 22 financial statements, but also previous years.
Right. Okay. So, and furthermore, PwC, who's Credit Suisse's auditor, issued an adverse opinion on the effectiveness of the bank's internal control over financial reporting as well. So now, of course, when I start hearing, these adverse opinion on internal control over financial reporting, the nerdy accountant in me and the former auditor in me gets intrigued. And so I did dig into Credit Suisse's filings to try and see exactly what the issue was, because management's report on internal control over financial reporting did further state, and this is kind of a quote, I think word for word, management did not design and maintain effective controls over the classification and presentation of the consolidated statement of cash flows. Specifically, control activities over the completeness and classification and presentation of non-cash items in the statement of cash flows. This all stemmed from those revisions that we mentioned that were made to the cash flow statement in the 2021 annual report that the SEC was calling about.
All right, I love it, Chris. So now we're getting down to accounting talk today, huh?
Oh, accounting talk, and even better than that, the good old statement of cash flows.
That is fantastic. So I know you kept digging into this issue. Why don't you tell everybody what you found? And is this something that was complicated?
It was sort of complicated, sort of not. So yeah, let's break it down a little bit. I took a look at the 2021 annual report where they actually disclosed this revision, right, that they made, and that's what triggered the ineffective control that we just mentioned. There were actually two main issues, or a few other little ones too, but two main issues that were disclosed. The first was issues with respect to the netting treatment related to the presentation of a limited population of certain securities lending and borrowing activities. This issue caused the balance sheet and cash flow positions for both assets and liabilities relating to these activities to be understated. In addition, the bank's leverage exposure increased, which reduced the related leverage ratios by 10 basis points. Unfortunately, the rest of the disclosure, which does provide amounts that by which the various financial statement line items change, doesn't clearly highlight the specifics of the issue, or at least it didn't highlight it to me. And honestly, to the average reader of the financial statements, it probably sounds more like technical bullshit jargon that no one understands.
The Christmas Vacation reference. Very nice, Chris.
Yes. All right. Well, thank you. Had to get that one in there. It seemed perfect, but but seriously, it was difficult to kind of figure out what that issue was. I mean, we had sort of the highlight, but what's going on? And Bob, I know you have an affinity for securities lending and borrowing arrangements and repurchase agreements and all that good stuff. So thinking about what they said and the impacts on those line items, what are your thoughts? Can you shed some light on this?
PCAOB inspections and the associated inspection reports can bring stress to audit engagement teams everywhere. If you want to improve your team's audit quality and reduce the number of potential deficiencies in your reports, Gap Dynamics can help. Join us for our upcoming webinar, Improving Audit Quality, on Tuesday, April 25th, 2023 at 11 a.m. Eastern Time. It's free to register, and you'll hear directly from PCAOB inspectors about risk assessment, internal controls, supervision, and review. And the best part, you can receive up to 1.5 hours of CPE credit. Register now at gapdynamics.com. That's Gap with 2 A's, dynamics.com, or simply click the link in the description. Hope to see you there.
So obviously, not being on the inside, we don't know exactly what's going on, but based on the adjustments that were made and kind of the things that were said in their disclosures, what I surmise from that is this is the securities lending issue is just a good old fashioned balance sheet netting issue that they ran into. Because balance sheet netting is not the most sexy topic, at least from an accounting training perspective. I don't get excited talking about balance sheet netting, but when it comes to materiality, I mean, it's probably one of the biggest issues that can affect your balance sheet, at least. And certainly in the financial services world, you see huge balance sheet netting that takes place. And what we're seeing here is an issue surrounding securities lending and repurchase agreements. So first thing is when it comes to balance sheet netting, the only time we can net in the balance sheet is when we have a situation where there are determinable amounts owed to each party in the transaction. So we know we owe certain amounts to them. We have the right to offset, right? So there is some kind of master netting agreement in place. We have an agreement that says we're allowed to settle our obligations to each other, right? Because we have a receivable and a payable, and we're saying we have the ability to net that exposure to each other. And it's enforceable by law, of course. But then the key thing is that we have the intention to net, meaning, even though we have the right to net, even though we have determinable amounts, when it comes down to it, we're actually going to settle this on a net basis. And that's usually the one that fails for a lot of companies because it's just easier to settle on a gross basis rather than worry about these net exposures. And therefore, a lot of times you don't get balance sheet netting, except in the case of derivatives and repurchase agreements. Okay. And with derivatives and repurchase agreements, they have a little bit more lenient rules with regards to offset. And the big thing being, without getting too into it, is just simply this intention to offset is not required. So as a result, banks often will be netting their derivative exposures and their repurchase agreements. Okay. So what I imagine happened here, okay, from reading, and by the way, we're talking about US GAAP, Chris. I want to make sure that's clear because IFRS doesn't have these loose netting agreements. And being that it's Credit Suisse, I was kind of like, well, maybe this is an IFRS issue, but no, they're reporting under US GAAP. So from reading this, what I'm thinking happened here is they probably had a portfolio of securities lending arrangements, securities lending and borrowing arrangements that they somehow erroneously considered repurchase agreements because they're very similar transactions. They're just, it's really what comes down to what's the purpose of that transaction. So they might have been netting it as if they were repos, when in reality, they discovered that they were securities lending. And therefore, we ended up having a balance sheet adjustment of 13 billion Swiss francs. So kind of a large number there for just one isolated portfolio, as they like to explain it as. So that resulted in the increase of both assets and liabilities of 13 billion Swiss francs. On the statement of cash flow side, they also had a reclassification out of investing cash outflows and into financing cash outflows. What that tells me too is they treated it originally as if they were repurchase agreements, meaning I was making an investment, I was lending money, right, on a short-term basis, on a collateralized basis, and I was just getting a return and investing cash flow. But when they discovered these weren't repos, they weren't investing transactions, they were actually securities borrowing transactions, they also had to reclassify the statement of cash flows out of investing cash flows and into financing cash flows. And that was an adjustment of 70 million Swiss francs. So that's kind of my best guess of kind of what was going on with that first transaction. So that's, who knows if that's really what was going on, but hey, it's a good opportunity to remind ourselves about the netting rules under US GAAP. So what about the second issue, Chris? Do you want to take us through that one?
Sure. I mean, the second issue cash flow statement was impacted here, and this second issue relates to what they refer to as non-cash exchange rate movements. Okay, so non-cash exchange rate movements, leading me to believe that we're talking about exchange rate movements for items that that are still impacting or in the financial statements. We don't have like true transaction gains or losses here. We're dealing with remeasurement or translation of items in the financial statements. The disclosure states that the group also expanded the elimination of non-cash exchange rate movements related to certain operating, investing, and financing activities in the statement of cash flows. Then, of course, it goes on to disclose the amounts and the line items impacted. Again, like your issue, Bob, it's hard to know exactly what the issue is or was, but I have a feeling, and a pretty good feeling, that it relates to a very common error that is made when dealing with foreign currency in the statement of cash flows. This issue has been widely publicized, but yet companies continually get it wrong. The Journal of Accountancy wrote an article about it a while back. I actually wrote a blog about it back in 2018.
Yeah, that blog is very famous within our company, Chris. That's the famous Plug the Flow blog. Believe it's one of our top 5 blogs of all time on our
It, it
website.
it is, and I don't know that it's because of the author. Hopefully, not because of the title. We are talking about an accounting plug in the statement of cash flows, but hopefully, it's been popular because it's a common pitfall and a commonly misunderstood aspect in the accounting literature.
So why don't you tell us about this issue a little bit?
Yeah, absolutely. So, the issue again, a common one that occurs out there. It's not a new issue because the underlying literature on foreign currency, which is ASC Topic 830, has been around for longer than most of us have been in practice. But again, the issue continues to crop up. So, it's clearly stated in the literature. But it certainly continues to happen. So let's get down to it. So ASC Topic 830 prescribes the accounting for foreign currency within the statement of cash flows. And it states that when a company has foreign operations, the foreign currency cash flows have to be translated into the reporting currency using the exchange rates in effect at the time of the cash flows. So same idea as the income statement. Of course, just like the income statement, an appropriately weighted average exchange rate for the period can be used if it gives you a substantially similar result. The statement of cash flows then must report the effect of the exchange rate changes on cash as a separate part of the reconciliation of the change in cash during the period. Okay, so what that means, translation, is when the consolidated financial statements are prepared for a company that has foreign subsidiaries, the statement of cash flows has to be translated to the reporting currency and the effect of the foreign exchange rate shown. Okay, great. That's what the literature says, but how do we go about doing that? So let me start with what usually goes wrong, and then we'll talk about how to do it right. So the wrong way to do things: when preparing the consolidated statement of cash flows using the indirect method for a company with multiple foreign currencies, oftentimes financial statement preparers base it on the consolidated balance sheets for the current and prior periods. The problem with this approach is that the consolidated balance sheets contain foreign currency balances that have been translated using a period end rate. That's what's required by the accounting guidance related to the balance sheet. However, as we said earlier, ASC Topic 830 requires foreign currency cash flows to be translated using the exchange rate in effect at this time of the cash flows. So the difference between that and the period end rate oftentimes is material. So this effective exchange rates on cash that has been, some company basically, if they do it the wrong way, we'll have a line item in there that has this effective exchange rates on cash being presented. That is required by the guidance, but it's not the right number. It's essentially a plug to make the statement of cash flows work. And this number should not be a plug. Other companies, I've seen it where they'll bury this number in some other line item in the statement of cash flows, and that's clearly wrong as well. certainly this is an easy way to prepare the statement of cash flows, but it is the wrong way to prepare the statement of cash flows. So what is the right way to do it? Well, the right way to do it, if we have to look at properly translating, and you have multiple foreign, currencies or subsidiaries, that use foreign currency, the right way to prepare it is you actually have to translate all of those individual statements of cash flows. So you prepare the statement of cash flows for each of the subsidiaries, including those foreign subsidiaries. They're done in their functional currencies, and then they are all translated using the appropriate rates that, either rate in effect on the date of the cash flows or, the weighted average rate during the period as required by AC 830. And then once all those have been translated individually, then you combine those individual cash flow statements with elimination entries, right? So it's like it's a consolidation that's going on, and that creates the consolidated statement of cash flows. So this takes a lot more effort, but this is what's required by the standard. And ultimately, you will have a line item that is the effect of, exchange changes in exchange rates on cash flows. That number is actually a provable number. And there's a formula. If you go take a look at the blog or that Journal of Accountancy article, we'll talk about it. But there's actually a formula that will prove that number is accurate. It used to be I remember many years ago, Bob, when I was in practice, it was a little, I always thought this like magical trick by the partners on engagement teams that would say, okay, hey, that cash flow statement's wrong. Why? Well, that number's wrong. That effect of changes in exchange rates, right? And they had just done the proof, right? That's kind of the story. Now, in no way do I think that Credit Suisse just started with their consolidated, balance sheets and created a statement of cash flows. I don't think it was that egregious. Obviously, they know the rules. This is a pretty sophisticated organization. But what probably has happened is that somewhere in that, very complicated organizational structure, there were some foreign, at least items being consolidated, and then the rates that were used ultimately in the translation weren't the right rates because things had been consolidated prior to preparing the statement of cash flows. So I would guess that, it's this issue. I don't, it's related to this issue with how to prepare these things, but it's probably buried pretty far deep down into their consolidation process.
Chris, I appreciate that. And, it's fun seeing you get all hot and excited when we start getting into this nerdy accounting stuff. But, while I know you could probably keep going on and on about this, I think we have run out of time for our podcasts today.
All right. Well, it was good, Bob, to get back into some discussion of accounting. It's fun when you have something that's both in the news, it's hot off the press, and it relates to accounting. I mean, let's be honest, we don't get that all that often, right? So it was fun to take you through. Hopefully that was helpful, for people to sort of understand some of these issues that are going on. But we'll save more for another day. So, Bob, why don't you take us out?
Gladly. That's all for this episode of Gap Chats, your source for all things accounting. Notes and resources from today's episode are linked in the description. And as always, you can find us online at gapdynamics.com and at Gap Dynamics across social media. It's never too late to become a gapologist. Head over to our website and subscribe to our blog so that you're the first to know what's new with Gap Dynamics.